For more insight on how the Fed's action today could affect markets, let's bring in Noah Blackstein, Senior Portfolio Manager at Dynamic Funds. 25, I don't know, it's not going to end the world. You think that's what we get, Noah, just so they can say, yeah, we're still paying attention to inflation, that we're not going to let that stay out of the bag, but we're aware of some of the risks to raising, so they go 25?
I think they will go 25. I think they'll unfortunately go 25 because I really don't think they should raise at all. You know, I've heard this theme more recently on the balance between financial stability and price stability. And it's some sort of economic trade-off that in reality, there are long lags to what they have done with one of the most aggressive tightening cycles in history. There are also clearly credit problems. And most economists seem to not understand how credit works and the multiplier effect, or as Bernanke called it, financial accelerator effect of problems in credit. And so they probably shouldn't do anything. It is not a trade-off between price stability and financial stability. Financial stability and credit really are what should matter most to them. My concern is that they could make a very difficult situation a lot worse. People are one-offing Silicon Valley Bank, but on First Republic and on Signature Bank of New York, you're talking about, top 10 commercial real estate loan portfolios in the United States. And even if you look today, some of the office REITs, stock prices are 40% below the COVID lows. Now, while all commercial real estate isn't necessarily that dire of a shape, there are knock-on effects versus the one-off and future signaling of where things might go. So since the risks are asymmetric to the downside, maybe they feel like they need to go 25. Getting into debates on Twitter with academic economists isn't really the issue. The issue is credit, and erring on the side of caution is probably the best idea. Whether they do that or not, I don't know, but they certainly didn't see this one coming.
I mean, we've heard for years that when interest rates are negative around the world at times or zero for an extended period of time, that just by definition, money's going to go to take some risks that it probably shouldn't. So we understand that outcome for staying at zero, but I don't know if we understood how many people go in long duration assets, and not just treasuries, but some of the things you were just describing. A lot of these things, what is being carried on companies and individuals' books says one thing, and if you had to sell it today, it's a completely different number. I mean, you can imagine, what if we thought about issuing 100-year bonds? Are those money good? Are 100-year bonds or 50-year bonds money good? Can you say, I can value those at par if interest rates have doubled? Noah, how much of a problem is this, the duration risk?
Well, I think, the longer end and the longer parts of the bond market are plunging in terms of where interest rates are. And the further they go on the shorter end, the more risk they bring into the long end. The problem is on the credit side a 100-year bond is money good because they print the currency they're going to pay you back in. So, there's never going to be a problem with that. It's certainly not going to be what you think it is longer term because, obviously inflation eats away at the value of what that was. But, there's a lot of other things going on. So for people to be dismissive of one-offs and not to look at the lag effects of what they've done, it's important. So my biggest concern is what they do. Clearly, there are areas of the market, you've seen this tech rebound and obviously in growth stock rebound, which I think is sustainable longer term. But you do worry about some of the policy decisions. I call this sort of long COVID economic policy, where one bad policy decision after another has been made since the onset of the pandemic. And we're just hoping to get past that. But I do worry a lot about just this dismissal of what's gone on in banking more recently, especially given how much of since 2020, regional banks accounted for a huge portion of loans made to the U.S. economy. This steady bleed of assets will continue as long as money market funds are well below deposit interest rates, and that goes to probably to the top 5 city banks.
Sorry to interrupt.